So this is a video about the impact of COVID-19 on equity markets, on stock markets. So what I have is on the screen is a website called tradingview.com. You can access it free. And there are other websites like this that you could use easily. I just happen to personally like this one. So on the right-hand side, you can see my watch list. SPX refers to the S&P 500 index. It's the 500 largest companies in the world, mainly in the US. And it is a combination of 500 companies that are meaningful in their size. It includes large with respect to the market capitalization, the value of the company, and or price to purchase the entire company. And then I have the Dow Jones and the Nasdaq that are different kinds of indexes, where Dow Jones is more industrialized companies and Nasdaq is more new startups and technology companies and so on and so forth. And I have a few companies here like American Airlines, Exxon, Boeing, Marriott, JP Morgan Chase, Bank of America, Disney, Ford, and so on and so forth. So again, no particular reason, just for the sake of this lecture. So at the beginning of this year, we started out with just a normal year, and everybody was happy. We just came out of Christmas and the New Year's and all of that. And then, we started to hear news about this strange and weird disease in China. But the market didn't seem too bothered with it. And I think it was more focused on the fact that 2020 is an election year. We also had other expectations within the usual financial markets. But then somewhere around the end of January, we started to become a little more worried about what's happening in China. And then the Chinese financial authority, the regulatory power, started to provide stimulus for their own economy and for their own financial markets. But this was considered to be really well. So the index level actually shows us almost like an average price for the 500 stocks weighted by their value. So as the price goes up, that usually means that people are becoming more and more optimistic, and they don't mind paying more for these stocks because they do expect their earnings to be higher, or they have positive expectations. So as we worry about what's happening in the market, we lose that expectation, and therefore we are not willing to pay as much, and therefore the prices drop. But then when we hear there's going to be stimulus and the government is going to be paying money to individuals or companies, then we become more hopeful. The companies will work more or will have better earnings, better returns for us, and therefore we're willing to pay more for these stocks. So the prices on average increase all the way to a level of almost 3,400. Now again, this is almost like an average price for these 500 companies within this index. It's a very main and indicative index for almost a global financial market health. But at that point, we started to hear news that this is a really bad pandemic, and that it still may be local to China, but it will have very serious impact on the economic conditions of at least Asia. So that kind of dimmed the expectations of stockholders, as to the earnings of these companies. So keep in mind that you are a shareholder and you own or you're a partner to a company, and your sole purpose is to make a profit. Otherwise, why would you become a partner to a company if you're not going to make a profit? And as the company makes, better earnings, they have better income, they will, as a partner, you get better earnings and better income. But if your prospects of making income or of having higher earnings dims down, then you're not as happy to be a partner to that company, and you may want to walk away. You may want to look for other companies. And as the price of your investment drops, you feel the pressure that you don't want to lose money. So as the prices drop, people become worried about the value of their portfolio, value of their investments, and they started to walk away. So as they sell their investments, prices on February the 24th, the last of third week of of February, prices drop about 200 points. That's about 7%. That's the first time actually that we noticed or we found out there's actually something called a circuit breaker. So what happens is when the markets drop too much, New York Stock Exchange and NASDAQ, these are the exchange floors where the stocks actually trade. Where New York Stock Exchange has an actual floor, NASDAQ is more an electronic floor. But when the prices drop so much, like 7%, they basically these exchanges, these floors just basically says, stop, and just calm down, go get coffee, 10 minutes, 15 minutes. And then they let people back in and continue trading. And if there's more trading, we stop again. And if there's more price going down, then we say, let's call it a day. So anyhow, as things get worsened, the markets became more and more panicked and more panicked and more panicked. And we realized that this is not specific to China or Asia. This is not a pandemic, this is an epidemic. And it's going to affect the US. And we started to hear numbers every day, thousands of people getting infected and thousands of people getting requiring ICU, and hundreds and hundreds of people dying every day. So that panic led everybody to get out, sell their investments and get out. And that panic dropped the market on average from 3,400 all the way down to about 2,200. That's about a 40% plus drop. Now, that kind of a drop gives us a panic. And a lot of people at that point feel that they lost significant portion of their portfolios. And think of it not within a student sense, but from an investor perspective. Say you're about to retire and you accumulated yourself $100,000 of a portfolio, you just lost about 40% of it. That's now 40% of your entire retirement is gone, or the value of it. And if you had $1 million portfolio, you just lost about $400,000. But unless you sell it, you're not realizing the profit. The loss. So some people panicked, and because of that, prices actually started to do this. But then, at that point, Fed and the Treasury, the Senate and the House, they actually came with the stimulus packages, and the Federal Reserve, our central bank, and the Treasury started to become more and more active participants of our financial markets. So much so that our central bank, Federal Reserve, started to buy bonds, and they started to talk about how they could actually buy stocks in the financial markets. That created a huge optimism in the market that our government is behind us, and they are promising that they will try to help as much as they can. And obviously, with significant resources, this promise from the Fed and the Treasury and our politicians was well received. So the market started to recover, and a lot of people at this point thought that it has dropped a lot, and therefore this is a good opportunity to buy cheap, right? So the stocks are at a 40% discount. Let's buy. It's a sale. And at that point, the state started to close, businesses started to close, and coronavirus cases started to decrease. So we started to feel that perhaps worst is over, and there were talks about a new medication, not a cure, but medication that lowers the fatality rate. And then they started to talk about vaccines. And then we received about a $1,200 check per per citizen or per resident in the U.S. And that actually became better news for consumer or companies that depend on consumer purchasing power. Meaning, if people have more money, they will be more willing to spend, and therefore, hopefully, there will be a jumpstart or back jumpstart to the economy. And since then, the market has been on a recovery path, slowly but surely. It looks like there's a recovery, but obviously there is there's a loss. You see how the price was right around here at 3,400, and now we've been trying to break above that 3,300. So there's about 100 points of a loss, which is not even 10%. But think about how the economy was closed about a month and maybe about 6 weeks, almost completely, and that's a drop in our GDP. And they just announced it the other day that the GDP actually collapsed a little over actually over 30%, first time in our history. So this is the biggest drop ever that we have seen in such a short period of time. However, there's hope. There's a new stimulus package that's coming around. There's a couple of vaccines that everybody's talking, and if all goes well, then hopefully we'll recover. But then the bad side of the coin is that we start seeing numbers increasing, coronavirus cases increasing, and some of the states actually slow down the reopening of the economies, and school closures. Some states are opening full on site. Some states are considering to open full online, and that's a total mix of who's doing what. And so we'll watch and see. Now, with respect to the sectors, which sectors were most impacted by this, I just pulled a website by SBDR, which is an ETF management for our purposes right now. And I'm just going to look at and evaluate or talk about some of these sectoral ETFs. An ETF is a portfolio of companies, in this case, that operate in these specific industries or sectors. Now, XLC, for instance, is an ETF that you could trade very much like a stock, and it's a portfolio that includes stocks within communication services. So let me go into Yahoo Finance just to see what companies are included in XLC. So XLC. So this is again an ETF that Communication Services Select Sector SPDR, that's the management company. XLC is the symbol or the ticker code. Right now, this one share of this trades at $58.13. The complete value of this asset is about $9 billion. And if you look at the holdings, This is an ETF, a portfolio that you can buy a share if you want to. Again, not suggesting, just talking about educational purposes, lecture purposes. But this portfolio includes shares from Facebook. In fact, Facebook makes 21.56% of this portfolio. So that's a major holding. Then you have Google, which is also in total, this is the institutional, this is the individual, so that makes about 22%. So that's actually the biggest holding of this. Then you have T-Mobile, Netflix, Activision, AT&T, Comcast, EA, Electronic Arts, and Charter. So again, ETFs are convenient ways to invest in a portfolio. And in this case, I'm focusing on just for the ease of this lecture, on a limited number of sectors and indexes, sectors and industries. And these are the ETFs portfolios that signify or that trade or include these in their holdings. I'm looking at the time frame year to date. So that's from January 1st until today, August 1st, which is a Saturday. So you can see the S&P 500 overall is now at a positive of about 1.25%. And communication services are higher now, perhaps because we've gone online, about 8.39%. Consumer discretionary are 9.23%. Consumer staples are about 0.5% down. Now, the worst that got impacted by this, you can see, are the energy sector, oil, and that's down about 40%. And this is as of today. So for the past 7 months, energy sector got impacted so much that they're still down about 40%. Now, remember how we had a recovery almost for the S&P 500 overall. Now we're looking at what makes the S&P 500 and into groups of companies within certain sectors. So energy is down about 40%. Financials, these are the banks and insurance companies and so on and so forth, they're down about 22%. And then industrials, about 12%. And then you have the real estate and utilities that are down about 6%. So the winner of this all is the technology companies. So these are up about 20% and a half. And perhaps it's because we're home and online is now the new way to go. Companies like Netflix or Amazon, with their online services seem or Zoom, now that we're using it in our everyday almost communications, seems to be benefiting out of this home confinement. I also prepared a little bit of a price changes. So what I did is I put down the lowest price that these ETFs have seen, and then the highest price that these ETFs have seen within the past 7 months. So year to date. So that's from January 1st until today, the August the 1st. What price was the lowest for these individual ETFs? What price was the highest? And what was the average price? So for instance, for S&P 500, I looked at an SPY, which is an ETF that you could actually trade. And then I looked at the materials, communication, energy, financials, industrials, all the ones that we actually looked at it right here. Right? So the average price, low price, and then the high price. So for instance, for the materials, in fact, let's look at the technology, right? So if you look at the technology, this ETF has seen as low as $70 and as high as $110. And on average, the price was $94.48. So the range from the lowest to the highest was about $40. And from the average price price has actually fallen 25% during this epidemic. So in the preliminary videos that lead into this lecture, we talked about the return, we talked about the risk. Now that you're looking at the returns, energy had the worst return, and financials had the second worst, and then industrials had the third worst. And with respect to the winners, you have the technology, you have the consumer discretionary, communication services, and so on and so forth. So, but if you now look at overall, which ones were the riskiest, then you actually see how, even the technology wasn't all that well. I mean, yes, they came up significantly. And in fact, they're now up about 20% from their January 1st levels, but they have gone down to $70 and then up to 110 and an average price of about 95, which means from the average price, they have fallen down to 70, which is about 25% of a drop. So within these, if you look at this, the highest risk actually belongs to the energy. And there is no question about this. This was the worst return and the highest drop, highest risk that we have seen. Then we have the industrials. And again, we have the, about 12% drop from January 1st. But then this actually dropped the most compared to, or the second most compared to the average price it has seen during the year. The average price is calculated as the average price every day since January 1st. Then we have a 29% right here, the materials. These are the worst three. Obviously, the consumer discretionary or real estate, they're very close followers of this. But if we were to go with the, fairly lower risk, we would say consumer staples was at 18.54%. And I think that's the only one that actually had a risk less than 20%. So if you look at the consumer staples, that actually dropped about 0.5%. So let's look what companies make up that ETF, XLP. So I use the Yahoo Finance, click on XLP, consumer staples. Let's look at the holdings. And we have companies such as Procter & Gamble, PepsiCo, Coca-Cola, Walmart, Altria, Mondelez, Costco, Philip Morris, Colgate, and Kimberly-Clark. So, and in fact, Procter & Gamble makes up about 16.5% of the entire portfolio, and PepsiCo makes about 10%, and Coca-Cola. Just these two beverages make up about 20% of this portfolio. So this is primarily the impact of the coronavirus epidemic or the COVID-19 epidemic on the equities, on the stocks. Obviously, we can talk about this in a lot more detail, but for the time, if you have any detailed questions, please do let me know. But for the time being, this is an ongoing situation. It's not resolved yet. We're still waiting for a vaccine. We're still waiting for our numbers, new cases and hospitalizations and ICU cases and fatalities to go down to a level where we can freely go out and for the companies to operate and to get back to their old self and generate our earnings. So that's all I have for today. And please do let me know if you have any questions. And thank you for watching.